Welcome to another episode of Making Risk Flow. Today we've got a very special episode focusing very much on cyber and AI. And it's a pleasure to be joined by Jonathan Spry, who's the co-founder and CEO at Envelop Risk. First of all, Jonathan, thank you so much for joining me today.
It's a pleasure. Great to be here. Well,
fantastic. So let's start with an overview of your background, Envelop Risk, and then we'll deep dive, I'm sure, into what you do in terms of AI and cyber.
Yes, of course. So I think Envelop Risk is now just over 8 years old as a company. It's the product of a few introductions that I was lucky enough to have probably 10 years ago. There was a real element of serendipity in being introduced to a group of AI practitioners and risk experts from the US. They'd both mostly been working together in the sort of defense, aerospace and space industries, and were involved in early stage quantum computing and writing quantum software that had some real discipline in AI and a desire to tackle real world problems. And the product of a few meetings was that we convinced each other to quit everything else we were doing and build a new company to tackle the opportunity around cyber insurance. And we did that by building Envelop Risk. Prior to that, I had a securities route around investment banking and the reinsurance and insurance industries. I think it was about 10 years ago, a little more than that I left my last sort of proper job, if you like, in investment banking and decided to go the route of entrepreneur. And whether that was a brave or stupid decision, I'm just so pleased with where we've got to now, and really enjoying my life on that side of the fence.
And what did you say? You said that there's a component of serendipity. Why cyber? What did you see in cyber that you thought this is the right line of business to do things differently?
Yeah, I thought that cyber anyway would become a perfect use case for data-driven approaches to underwriting and capital management. But actually, looking back 10 years ago, cyber was still in a relatively nascent state of development. And it occurred to me that what was missing weren't just distribution solutions and an ability to sell the products, but actually the cyber insurance industry was lacking fundamental infrastructure. And by fundamental infrastructure, I really mean capital in the form of reinsurance and analytics, or certainly advanced analytics. And the idea of Envelop was to combine the two things together. So we would go off and gather capital and then allocate that using the reinsurance technique, which is, of course, very well recognized, a very familiar capital management technique for insurers, but also to embed analytics, particularly portfolio level analytics within the industry, and overcome some of the myths, I think, that were surrounding cyber, which is that there was insufficient data. And actually, it was obvious to the team early on that there was actually a huge amount of data around cyber, and actually data that we could use to make a real difference. Cyber became a particularly obvious choice as a place to start. The fact that it was exciting, complex, and emerging risk really caught our imagination. But equally, the fact that it's a sentient, if you like, or adaptive type of risk means that to really grasp the trends and understand the challenges that the risk presents to insurance, you really needed to use more advanced techniques, and particularly extract the full value of machine learning and AI. So to that degree, I think cyber has always fitted like a glove to Envelop Risk and really has become our obvious use case and a really important shop window really into everything we do on the AI side.
And then when you think about using more data and better analytics to underwrite cyber, does it mean capturing more data about cyber risks, or is it more about just capturing similar data than the rest of the market, but really applying a layer of insight and analytics on top of it?
So it is definitely both. And for AI to really work, the conditions that need to hold are access to superior computing power, access to data, and then sophistication in what you do with that data. And that really means better algorithms and better data scientists. We have all of that now, not just to do Envelop Risk, but our industry has an opportunity because the conditions now hold that are required to make best use of AI. clearly quantity and quality of data are really important. And I think the ability to source data, whether it's through private means or public, and the ability to source data directly from your transactions, from your business. And Envelop is well known for having a no data, no deal philosophy. That is something that we adhere to rigidly. And the benefit of that is that having now underwritten cyber reinsurance going back to 2018, we have a particularly rich data set, and that provides additional insights. More data means more business, means more data. So you absolutely need a strategy for acquiring data, and then you need to be sophisticated in what you do with that.
Yeah, but it sounds like it's a mix of whenever you're looking at specific risk, you try to capture data externally available, right? And then it sounds like at the same time, you are leveraging the insights from your existing portfolio to analyze any risk. Is that how you think about it?
Yeah, absolutely. So you could view that as a sort of positive flywheel of data, enriching your insight. Insight then creates the appetite for more business. You can then attach more capital, and if you like, diffuse that into the industry, all of which then assists with product development, depth and breadth of coverage for insurance, cyber insurance, which in turn, of course, produces more business and more data. So I think at the heart of Envelop Risk is this flywheel, which just grows and continues to propel the growth of the underlying cyber insurance, which ultimately is what we're really interested in. We choose to use reinsurance because we feel that's the best way to manage the capital and to bring new sources of capital into cyber insurance. But it's the growth in the underlying cyber product that most interests us and really is propelling the growth of our company.
Yeah, and when you're thinking about growth and how you use this superior insights, are you thinking about, especially as you compare to your competitors, are you thinking you are better at identifying profitable risks that others might not be able to identify in the absence of those analytics? Are you thinking you can more accurately prices? How do you actually compare to others?
Yeah, so I think in terms of what we do differently, the competitive edge, if you like, I would say that risk selection is extremely important. But actually, perhaps the most important thing is portfolio optimization and understanding risk at a portfolio level, which is something that we have to do with reinsurance, but actually is something that the reinsurance business allows us to do because we take on risk at a portfolio level. And really what's driving the performance of our book of business, if you like, the return on capital for our various capital providers, it is much about the aggregation of risk, the tail risk, which is what we really obsess about here, but really an understanding of the correlations, systemic risk within cyber portfolios. And more than anything, it's trying to understand inference, statistical inference, which in our case means various forms of machine learning and AI, but really what we're trying to do is perform causal inference. So we're trying to understand what is driving the performance of the portfolio over time.
And then that is there also a component of capital efficiency by avoiding aggregation or?
Yeah, and actually what we are trying to do is deliver the right mix of risk and return to the capital provider, and the tolerance, the preferences for risk may be different for different capital providers. And like many reinsurers and insurers, our metrics, which would be familiar to most of the audience here, would include things like T-bar. And actually, when we look at new transactions, we're not just looking at the price and the risk selection, we're looking at the marginal T-bar. So does the reward attendant to a particular transaction justify the additional T-bar? And that is actually not just a question of the pricing of the book. It's actually driven by whether the marginal benefit of that transaction adds to the portfolio. And the same question may result in different answers in terms of yes, no decision-making, depending on the attitude of the capital provider.
Yeah. So it's really looking at the marginal impact of writing in your risk in your overall portfolio.
That's right.
Yeah. Okay. And so going back to the kind of analytics, AI, obviously, when you started, the technologies has evolved tremendously in those 8 years. So would love to hear your thoughts on how did you think about analytics and potential use of AI 8 years ago versus now?
Yeah, it's interesting because I think 9, 10 years ago, AI was beginning to get more recognition in terms of its potential power, and some of the cynicism of using AI was beginning to erode, albeit it's not long before that there was really eye-rolling kind of observations being made about anybody that was talking around AI. And AI had so many sort of false storms throughout the 80s and 90s and then into the millennium. And I certainly go back and think about what my view of AI was very much linked to virtual reality and kind of gaming and so on. And I wasn't quite ever convinced that this was going to have a material impact on our world, and particularly the world of risk management. But in the background, we had industries, and I guess defense aerospace space is a good example of that, which had been embedding the disciplines around machine learning for a long time. And I think machine learning is sometimes referred to as good old fashioned AI. It's been with us quite a while. It's very well proven. There are new techniques and a big shift in how machine learning works, and the availability of compute and the sophistication around data science has increased so much that the results of machine learning are far more impressive than perhaps they would have been in the past. And of course, we have techniques in machine learning, things like reinforcement learning and even unsupervised machine learning, which really are breaking the arts of the possible around AI. But things have changed a lot just in the history, sort of 8-9 years of Envelop Risk. And you're right, kind of generative AI, large language models is obviously shifted hugely people's belief in the use of AI, but also I think has changed the paradigm in terms of what people think is possible. And for the first time within the last couple of years, we are beginning to use generative AI techniques ourselves. We found them incredibly useful in things like exposure matching. So just reviewing our portfolio and name matching, which may not be the most fascinating topic, but is incredibly important in reinsurance to actually understand that what you're modeling exactly mirrors the real exposure that you have. And we're really finding some true power in those LLM approaches in terms of our ability to overcome that sort of patchy data and problems that are inherent in modeling if your data is not clean and accurate.
Perhaps to bring all of this to life for the audience, can you give us at least a high-level overview of what does the end-to-end underwriting workflow look like at Envelop Risk? From the moment you receive any risk to the moment when a decision has been made?
Yeah, so in most respects, we are mirroring exactly the way reinsurance typically transacts. So most of our business's data is broker driven, and we work with the largest reinsurance brokers and those that have developed a bit of a niche offering or punch above their weight within cyber. The information we receive is pretty typical in terms of reinsurance information submission. If the broker or the client want to transact digitally or to a degree digitally, we're very keen on that idea. But ultimately, we will accept inwards bordereau in whatever format it arrives. What we have is a model which will map to most of the exposure that we see within the submission. So our model has many millions of companies within it already. It's not hard for us to add new ones. Getting a little bit more data about a company is important, but ultimately the URL, the naming conventions around the company, that really helps us. We then perform initial modeling. We model the risk economically. So we actually
But when you say you do model, is this an automated process or is it?
It's not fully automated. So we are certainly in the supervised use of machine learning, and we will perform runs of quite a large and complex model of economic cyber risk. We effectively view cyber as a global economy with threat actors, with defenses. We simulate some of that adversary versus defense response It is driven hugely by a desire to perform causal inference. So we're really looking for not just the answer to hypothesis testing as to what may be a correlation, but actually we're allowing machine learning to perform many hundreds, thousands of simulations and look for hidden trends as to really what's causing risk. The economic results are then produced, and then we map on the insurance and reinsurance terms. So clearly the insured loss, indeed the reinsurance loss, is not the same as the underlying economic loss. And the way we model insurance terms and reinsurance terms is an important part of what we do. We think of ourselves as structurers, if you like, financial engineers. We want to have a good view of economic risk, but also the ultimate portfolio level risk, like the OET, the AEP, all of those metrics with which the reinsurance industry will be familiar. We're mapping all of that to our capital providers.
And also, one of the points you made as you were going through the processes, you've got a database or information about thousands or whatever, a large number of companies. So is your approach to try to have that information almost pre-analyzed before you receive new risks? Or do you do that real time when you're kind of trying to analyze a single risk, you pull all that information together?
Yes, and we're typically modeling at a portfolio level. So much of what needs to be modeled for a new reinsurance portfolio will already be in our model. There may be some gaps. We may need to ingest further information, but the computing power we have available means that we can run the entire model in a relatively short period of time. And actually, that's something that's improved hugely throughout the journey of Envelop. And, a couple of days, I think, to begin with, is now being reduced to a matter of minutes, half an hour, something like that.
It is fascinating, this approach to cyber, but at the end, this concept of looking at the portfolio, the impact or the marginal impact of a new risk or a new portfolio into your book, etc., is something that surely can be applied kind of beyond cyber. So I guess two questions. One is, why have you chosen to stay within cyber? Are you thinking about expanding to other lines of business? But also, what are your thoughts on whether the same approach could be used in other lines of business?
Yes, I think in terms of our stickiness to the subject matter we love, which is cyber, I think cyber has grown and continues to outgrow other classes. I think in Lloyd's, it's still the fastest growing class of business at the moment. So that there is a lot to do with cyber, and there remain big protection gaps in the world of cyber. Equally, the world is not going to stop digitalizing. In the same way that software has been said to eat the world, I think cyber is eating the insurance industry. And a company like Envelop, we don't necessarily think of ourselves as a disruptive force. If anything, we're trying to build fundamental infrastructure to support growth of an underlying industry. The reason I say I would question whether or not we view ourselves as disruptive is that I see cyber itself as on a very disruptive journey in the insurance industry. And actually, if you stick close to cyber, what you begin to see is that cyber and that the risks that go with cyber will begin to prevail in terms of the thinking that's required to understand other lines or other classes of business. For example, autonomous vehicles will have a very large cyber and software risk component to them. We're beginning to see cyber increasingly creep into marine and aviation and space for obvious reasons, and even property portfolios where we have cyber as an underlying cause and a huge amount of focus around supply chain risks, business interruption, which for me is close to being the holy grail for insurance. I think alongside understanding climate risk, I think supply chain risk is probably the dominant force that we need to understand as an industry, and particularly where you start combining AI as an analytics technique, but also understand that AI is going to have an incredibly significant impact on the liability landscape. And that will likely cause us to reinvent what we think of as the insurance industry and risk management.
Yeah, that makes sense. So those are sounds like you're going to stay focused on cyber. Totally agree. It's like the fastest growing line of business. I think it's almost only started. But do you see the same approach you're taking to cyber being used by others in other lines of business too?
Yeah, I do. So partly because of what we just observed, which is that cyber itself each of those fittings. So as cyber becomes a dominant force in a form of liability or general liability, in a form of casualty in reinsurance or insurance, we will follow it and move into those areas because we understand it. In terms of whether you can use the same techniques, AI-driven, machine learning-driven, data-driven underwriting, however you wish to term it, for other classes of the business, absolutely, we believe you can. And actually some of the data, firmographic data, geopolitical data, economic data is so similar for other liability classes that we believe that becomes an option to do. And something that Envelop Risk will do in the future.
Earlier, that your approach, at least right now, is very much supervised machine learning. So almost call it augmented underwriting, right? So the technology is providing all the insights, but there's still an underwriter ultimately making a decision. So how do you see that evolving in the next few years?
Yeah, we're big fans of this term augmented underwriting. And I suppose we would be equally as fond of the idea of augmented capital management, augmented risk management. All that really means is we've got a human in the loop. So there's a human machine interface. There may be parts of the insurance industry which are now so rapidly digitalizing that they can take the next logical step and become automated and begin cutting the human out of the loop. I suspect that those are more personal lines class of the business and obvious reasons for that. Within the specialty insurance and reinsurance world, I think there is a human in the loop. It's a human that's developing in terms of skill set, maybe fewer of them, certainly as the underwriting role, but I'm not of the view that we're planning to remove the human underwriter from anything we do within the foreseeable future. And I think we benefit hugely from having human judgment, expertise, and the ability for humans to continue to create relationships and manage relationships, understand some of the market dynamics, if you like, game theory and competitive landscapes. I still find human judgment to be more telling and more rich in its predictive ability than relying purely on the machine.
Yeah, and that is, I share that point of view, and that applies to across, I would say, P&C and specialty lines. Having said that, typically what we see is almost regardless of the complexity or the of a line of business, there's always a subset of risks that are more, call it simpler, more straightforward, more homogeneous. So we are seeing some insurers and reinsurers thinking about, okay, I still want this augmented underwriter approach for most of the risk I see, but I'm starting to identify the bottom 20%, which are more straightforward, that I can start thinking about how do I completely straight through process those. What are your thoughts on that?
Yeah, I would agree that we're in a process now on the underwriting side and on the distribution and claims side of the insurance industry of digitalizing and automating where it makes sense to. And certain tasks now quite legitimately, I think, will be replaced by AI and do not need human intervention. I'm not sure that we are on a linear path to complete automation. And part of the reason for that is that actually I see AI as having just as great an impact and probably more of an impact on the liability side. So I think the subject matter of insurance, the risks that we trade, are changing more quickly as a result of AI than perhaps even the analytic tools that we're using and the underwriting tools that we're using that benefit from AI. So clearly the future of insurance has AI as part of the shield and sword that we use, but equally AI is actually going to be an increasingly big topic in terms of what it is we're trying to ensure and the nature of liability particularly. And there is a huge amount of discussion, as we all know, around generalized artificial intelligence or artificial general intelligence and the path towards AGI. I suspect that speculating on when or why and how that may happen is beyond the scope of this podcast, and I will avoid doing so because I frankly have no more or less clue on that as anyone else. But what we are seeing is some very important milestones, if you like, intermediate steps towards AGI as being quite short-term horizon. And already we see generalized learning within neural networks. We see advances in the large language models that perhaps even those architects of those models just a year or two ago would not have expected. We're beyond the point, I think, where we can realistically sit in denial that there is going to be some level of generalized learning. And something that I think Mustafa Suleiman recently termed in his book, artificial capable intelligence. So where the models are not just performing particular tasks, but are actually taking on complex multi-step activities on their own without direction. And that's going to be a phenomenon which I think is relatively short-term, has implications for what we do as underwriters and analysts, but also is going to start shifting along with other impacts and the ramifications of AI, start shifting what it is we're trying to ensure and reinsure.
And how do you, obviously you are probably a great example of using some of the more advanced thinking, latest technology, Envelop Risk. Kind of what's your process by which you start thinking, okay, I'm going to start using these all the technologies that you just described in your day-to-day operation. So how fast are you able to start leveraging that?
Yeah, we don't view our model as static at all. So the team that support the model, what we refer to as Envelop Labs, both here in the UK and in the US and elsewhere as well, but the home is right here in the UK, and the team keeps growing. The disciplines that the team want to use grow, and the expertise that we brought in has grown. What started as probably a conventional supervised machine learning approach to looking for trends and, if you like, painting a picture of the future and putting a confidence interval around risk, looking for some accuracy in terms of confidence without finding precision and trying to exactly predict the future. That is still the philosophy we've adopted. But like I say, we've introduced new techniques, whether it be something like reinforcement learning, whether it's the use of generative AI. We have an active and fairly dynamic management around the evolution of our technology. And we're fortunate that although we're probably past being a startup, we're more a scale-up company now, we can move very quickly. We're agile and lean in our thinking. We would not move the significant parameters of modeling without a process of road testing and without consent from our capital providers, because ultimately this is a model that we are using as custodians of their balance sheets, their capital. So we involve our balance sheet partners, our strategic partners in the dialogue around modeling. But in terms of the R&D in Envelop Labs, we can move very quickly and ensure that we're on the cutting edge of the use of AI.
And as you're thinking about where to apply kind of new technical advancements, quite often at least, what I see is you think about LLMs or Gen AI or new types of machine learning. Quite often, I think the adoption curve I see is, typically teams start using it for, it's almost like stage one is help my life to make it easier. So just help me with the routine activities, because that is to be like a routine area. Then once you've done that, you start thinking, okay, now help me interact with others and help me make decisions. So do you see like a similar horizons of adoption?
Yeah, I do. And I think that adoption mirrors the developments in AI more generally. So we see the task level AI already being replaced by something a little bit more capable. It is certainly not fully automated, and it's certainly not unsupervised and generalized, but it is more than just task specific. There is reinforced learning. There is the ability we already have AI, which has got to the point where it can improve itself, which is a really important milestone on the horizon. It brings with it risk as well, of course, but we have that. If we have that ability, that is exactly the ability we should be using in capital management, risk management, and in underwriting. There's still a huge amount more we can do with those techniques. and embedding more of a kind of the generative AI in the distribution landscape, we can still focus on the way we transact, and there's more to do in terms of digitalizing that functioning within a marketplace, which itself is digital. And equally, we can use the modeling and new techniques to assist with products development. And one thing we're trying to do is to help insurers fill the protection gaps. And to do that, we need to understand the demand, even the kind of inchoate demand, the demand that we don't yet know is there, but is beneath the surface for additional risk protection. AI can really help us understand that. We can understand behavior. We can understand what really is moving the needle for a company, whether it's an SME or a major corporate, in terms of the risks that they should be transferring, and actually influence a bit the decision as to whether to self-insure or to seek to buy insurance. And if so, to ensure that there is product market fit for the products that's being supplied, if you like. And reinsurance can help with all of that because of the analytics and the package.
So we focused quite a lot on kind of the AI space and kind of all the advancements in the last 10 years, but more specifically a couple of years. I'm also interested about, you mentioned that your background or early on you were focused on, also around quantum computing, which is probably an area where we've been talking about for a while, but probably has not reached that, I don't know, like key milestone from being something which is very promising to having real world in kind of use cases. Is that fair or not?
I think that's fair. And I should stress that I'm a long way away from being a quantum computing expert. I have been incredibly fortunate to be surrounded by and have great access to a number of those that are interested in that space. What I've noticed is two things. One is that the lure of and the growth in compute for training and for inference and the real world results that we're getting from AI is dominating people's thinking. And if anything, focus on quantum is maybe reduced a little bit.
Mm-hmm.
The second would be the quantum is always a few years away and never quite gets to the point of commercial reality, albeit there have been some important developments and movement. I'm absolutely convinced that quantum computing will play a role in the future analytics of risk and the insurance industry. I'm not going to give you a prediction as to when and avoid that obvious pitfall, but it is some years away. Clearly, we need in cyber to think quite carefully about the implications for quantum, particularly around encryption and whether or not quantum could lead to a catastrophe or even a substantial level of risk around breaking encryption and the whole role of cryptography and in protecting data and transactions globally. I would always stress that whether it's quantum or it's AI, almost certainly that those techniques will be used by our adversaries, so they will be part of the threat landscape. But equally, those techniques can be used as part of our defenses. And what we need to ensure is that risk management evolves just as quickly as the threat landscape, and that we do not deny ourselves the opportunity to realize the very best of whether it's AI or quantum. We need to extract the real value there, because otherwise the threat adversary will attach itself to that technology. And perhaps one example of that at the moment is the deep fake world. And we see movement quite quickly in that space, which is not openly concerning if we understand the risk and we use similarly advanced techniques to detect it and mitigate against it. But that's a space that's moved pretty quickly. We have these generative adversarial networks, which is an underlying technology which sort of simulates and allows networks to compete to produce better results. That is what's being used to generate these images, and whether they're moving images or voice equally. But those techniques can also be used as part of a defense. So it's about understanding the technology and its two-sided coin perspective as to what we can do to understand the evolving risk, but also to realize the best of those techniques to prevent real harm, catastrophic risk, or even the sort of existential risk that we sometimes hear associated with AI.
That is a good, plenty of thoughts on that one. I think I'm going to two key takeaways from what you just said. One is probably quantum computing eventually, we don't know, to your point, we don't know when, but eventually we'll have a chat GPT moment, right? Where it moves from being promising to being almost like broad adoption. So we don't know when that's going to happen, but I think that will, I think the other point, which actually I had not reflected on it probably enough, is the threat of something like quantum computing breaking the strength of all the cryptography, the basics of cryptography, right? At the end, most of the security online is based on password encryption using algorithms that current technology cannot break, but I think quantum computing might be, right? So I think that's probably almost like a theme for a movie, right?
It is. It's that merging of science fiction with science facts. And it's very interesting for sure. And I did a clear of making bold predictions as to what that's going to look like, but it's not going away. And we're beginning to feel it. The future may not be here, but as William Gibson said, it's here, but it's unevenly distributed.
I think that this is a brilliant way of wrapping up the episode. Jonathan, it's been fascinating to deep dive today into all things cyber, AI, technology. I've really enjoyed spending a bit of time with you, and thank you so much for joining me again.
Likewise, Mom, I've really enjoyed it, and it's been great chatting to you today.